Welcome everybody, thanks for joining me. Hope you've enjoyed the day. It's been a fantastic day here, so I hope you've had great weather as well. In fact, I'm probably slightly, hang on one second, probably slightly sunburned. Sorry, I'm clearing my own voice there, just stopped it. So yeah, just need to dive straight into this and start to pick our way through what we're seeing. So let's just go back to where we are at the moment with the whole virus issue. So a few things to note. First of all, I think we are seeing an unprecedented level of money coming into the market from governments and central banks. Gone are the days where we used to have inflation problems and interest rates were used to manipulate the markets and try to, in political terms, manage the markets. We've long since had a different environment, initially triggered by the fact that we have such an aging population. In the days when we had baby booms and we had high birth rates, we had something called inflation, and in the last couple of decades inflation has really dropped out of the picture, and that's created very, very different environment. So as we've seen a few major glitches, should we say, in the economies, particularly the 07-08 crisis, which states and central banks learned a completely new language at the time in which that was coming to effect. So what we're seeing now is a completely different way of managing crisis and managing situations like this. So with a demand shock like this, we're currently seeing over $3 trillion coming in from the Fed, and the level of debt the UK is talking about at the moment, I think it's something like 15% GDP. I actually bought the Observer today. I haven't bought the Observer for a very long time. My daughter-in-law happens to have a feature that's spread across page 20 and 21. If you guys have bought it, have a look at that. A very interesting article on Bonar that she studied Bonar for 7 or 8 years, I think. Anyway, back to the main thing. So where are we? So what I'm going to talk to you about in the next 5 or 10 minutes is just my take on where we are at the moment and what we can expect. And then I'm going to talk to you about how I'm handling this, what I see as good opportunities and the strategies that I'm applying to my pension as well as my income accounts. As a day trader, I'm looking to exploit short-term moves in the market, and as an investor and managing my own funds, I'm looking to really exploit, jump on the back of some longer term opportunities. So I'm going to start talking about shorter term opportunities initially, and then wind up talking about the bigger picture. I think the things to watch at the moment is, if we are going to try and assess short term whether this market is going to pick up, whether we have some more upside or whether we have more downside, I think the one indice I always look for is the Nasdaq. What the Nasdaq does, the rest of the market follows. That's number one. Number two, when we saw the initial pandemic panic and the real initial some market moves, the first thing we saw was the dollar getting bought, and because there was a massive liquidity problem with the dollar because of all the funds and ETFs that are tied up in that, and particularly situations like the fact foreign states have, particularly China, have huge stakes in US government bonds. So liquidity in the dollar was a major factor. And if you look at the way in which the dollar reacted on that first major leg and the second leg down in these charts, you'll see how the dollar got bought. So that's the first thing. If you are a day trader, then you need to stay focused on the VIX as well, the volatility index. We'll look at the volatility index in a minute. Most platforms are able to grab that, So we'll take a look at that, see where that is, and make a judgment call on that as well. And then, you know, where are the opportunities in this? Should you be buying? Should you be selling? Well, we've effectively got a split economy in terms of the sectors that have seen quite incredible spurts of growth over the last couple of months, and sectors that I've been bear rating certain sectors over the last 4 to 5 years at least anyway, and some of the sectors really sort of came to the crunch in the last couple of months. So let's just talk about initially short-term trading. You know, what can we expect in the week ahead? We've got not a lot of data coming through at the moment. We're just coming out of the earnings season, and we've got very little key US jobs, key US data coming up at the moment anyway. So we are currently sitting in a very tight range. If you look at this is the Dow index on the weekly. Is there anybody in the room that doesn't? It's possible we've got people in the room who are not experienced traders, people who are not used to looking at charts. So bear with me as I try and cater for those as well. But essentially, to cut a long story short, if we are seeing black bars, we are seeing buying. If we are seeing red bars, we are seeing selling. So, you know, it's sort of like a traffic light system. Lots of red up here, 1 week of black, a couple of weeks of red, and then there is more black than red here. So, but unfortunately, the last week was red. But essentially, what we are is the last 5 weeks, 1, 2, 3, 4, 5, yeah, 5 weeks, we've sat in a box, going nowhere. And so that's currently that's why as a day trader, that makes life a little bit tougher. As a day trader, you've got to be nimble, you've got to be very aware of what the trend is of the day, and if you get a trend in the day that's up, don't short it. And I have to say, hands up, I was shorting the market on Thursday, when in fact Thursday turned out to be a very bullish day. But it happens. Yeah, most of the time I get it right. I have very few drawdowns, but last Thursday, in actual fact, last Thursday we opened the room and there was a 200 pip drop. Later in the afternoon there was another 200 pip drop, but overall we were up 800 pips on the day. So that gives you a flavour of, you know, the sort of market we've got. So you need to be acutely aware of what the trend is of the day and try and not to fight it. And that was a mistake on my part on Thursday. I do make mistakes. I'm human. The markets are not always doing, not always operating as efficiently as they can be. Some days are more efficient than others. The question is, if you do get a trade that goes against you, you need to cut it short as quick as possible, manage your risk, and move on. And that goes for long-term trading as well. The ultimate success of a trader is going to be determined not necessarily on your ability to find the best trades and enter at the best price. Ultimately, anybody who is a short-term or a long-term trader, and that could be somebody who's just investing in funds, not necessarily dipping in and out of the market on a regular basis. Anybody who wants to master the markets has to be good at managing risk, because the whole business model of trading is the same as the business model in the insurance industry. You will have losses, but your losses must be smaller than your gains. And I've met many people who have made significant gains, and that's when some traders are at the most vulnerable, when they make gains and start perhaps not concentrating, perhaps they're euphoric. That's the point in which less experienced traders can actually make losses shortly after making gains. So to cut a long story short, let's get into the details of where we are now. and let's find out whether we should be buying or should be selling. So like I said, we've had, this is Fibonacci levels based on 2019. So that's the high and the low of 2019. This is a daily Dow. Now the Dow has been lagging the NASDAQ. We'll talk about the NASDAQ in a minute. And the reason why the Dow has been lagging the NASDAQ is because it's got a lot of industrial stocks, a lot of businesses with older business models, as opposed to the NASDAQ, which has a lot of, which is dominated by techs and healthcare. So that's the split economy I mentioned earlier. Is on the one side you've got industrials and retailers and even housing now. We'll talk about housing in detail in a minute because I think that housing is quite interesting, particularly commercial property. So you've got industrials, housing, retail on the one side, and then you've got healthcare. So I can't write this thing. You have to make notes. Healthcare, techs, and biotechs over here. And the other one that is, anybody think about one, a big one that should be on this side quickly? I'll give it to you anyway. The one that should be on this side is travel. Anything to do with travel, whether it's building airplanes, hotels, anything to do with that sort of public interface is on this negative side of the track, and then this is on the positive side. And that's why, to a large extent, that we're getting this chop, because of the split, we've seen growth on this side and some big issues on that side, including some insolvencies and collapses. And I think that's going to continue to be the theme of the coming, at least the next couple of months, at least, if not more. In the meantime, if we're just looking at pure technicals and just getting down to what is the chart, what is the chart telling us? Overall, the charts are holding up, and we are seeing some marginal higher moves here, and the lows are, at least we're not making new lows. So short term, there appears to be still reason at the moment still to buy. However, if we come up against this trend line here and this moving average and start to see some selling, then be aware that if we subsequently close underneath the 2019 lows, that could open the door for some more selling. So short term at the moment, as some lockdowns get eased and restrictions are lifted, both in the US and in Europe, and of course China has been lifting restrictions for a while since. At the moment, there seems to be short term, there's reason to hold on to stocks and buy dips at the moment. But however, if we get into towards June and July, this could be an area I see this as a real problematic area. And if this range continues, but we get to the high and reject the high of the box, then I think that's an area, a period there we need to be ultra cautious and potentially start to back away from the markets and think about reducing your risk and your exposure to the markets. So in terms of, let's just talk a little bit about the bigger picture in terms of you as an individual. If you're an individual and you are trying to manage your investments and savings, then I think you need to, as per that last image, concentrate on markets and charts that are holding up, and have some exposure to good quality stocks on this side, particularly the industrials and anything involving infrastructure, but just be ultra careful about the very weak sectors. If you have any exposure to very, very weak to these very weak sectors with any public interface, just be warned, just be careful. Okay, so in terms of the Dow itself, you know, we've had a new had 3 days of selling, you know, decent selling. I was short up here on Monday, gave some back, got short again on Tuesday and Wednesday, and then Thursday we saw, you know, quite a significant little powerful move up, and holding on Friday. I did go long on Friday, but I didn't hold it for too long. Grabbed about 120 pips and then walked away, because it was Friday, end of the week, momentum was stalling. So read the markets and decided just not to spend too much time sitting on a long. Okay, so short-term upside, but I'm just very, very wary of where we are coming into on that move up there. Now let's look at some other indices, and I'm going to drill down into other markets. So you can see, you know, the uptick, and this is the Nasdaq on a daily chart, and you can see the Nasdaq has been much more buoyant. You know, the upside here has been very, very significant. You've got something called TINA. TINA is there is no alternative. You know, why sit in cash if you've got decent tech stocks, decent health cares pushing up here? Because you're certainly going to get nothing in the bank. So engage the market, but engage it with care and engage it with measured risk. And you can see I've got this trend line drawn up here. We've had 3 attempts to get through this trend line, and at the moment we failed. So now here's a good area to be to think about. If we start closing under this 9,000, then I will suggest short term you need to back off this market, because like I said, what the Nasdaq does, the rest of the market follows. So if this is a potential 3-wave reversal and this market fails to penetrate this recent high, short term we could be gearing up for further selling. So at the moment we are holding this level here. The Dow is holding up. So all the time we are, this Nasdaq is holding, and we get some higher closes in the Dow, I will be buying. But if we get any selling at this point here into the coming days, or certainly, you know, into next week and into June, then I'll get very, very cautious. Okay, so that's an immediate level, and I think that's the way you've got to treat this market. You've got to treat this market, if you as a day trader, obviously take day by day. As an investor, you need to stand back and look at the week. There's no point in dashing in and out of funds based on a daily chart. You need to observe and think about what's happening on a weekly basis and try and make longer term decisions. What I'm doing in my investments and funds is just balancing the my risk more on the techs and the healthcares. I've been looking at healthcares for about 3 or 4 years minimum anyway, and I've been selling bricks and mortar retailers for about 4.5 to 5 years. So to some extent I've been on this curve for a while anyway. All this means is that, you know, the virus situation has just exaggerated that. The other thing to bear in mind is that something that people don't realize and don't often sort of grasp is that when you get a big shock like that, there is a lot of data been done on this, and on most occasions when the markets have seen a shock of that level, 12 months later the market is generally back to the highs, if not higher. So despite this catastrophic unprecedented drop to the downside, it's worth noting that 12 months later, on average, most markets are at the same, back to these highs, if not higher. Now, this Nasdaq is actually not that far off the zone anyway. In actual fact, what we've done is all we've done at these highs is not quite gap filled. We've come right into that gap and short term reversed. Now, gaps are really interesting parts of the market. Markets do not like leaving gaps open, so at some stage that's going to get filled. Now the question is, nobody knows if that's going to continue higher. You're going to close that gap and push up, but at some stage that gap will be filled. So bumpy route ahead. Markets have, well, Nasdaq has made an incredible recovery, and short term there is still reason to buy this market. Anybody wants to ask any questions or type in? Typing in a question is easier. If you then want to ask a question, then we can take that. I can turn the mic on as well. Right. In the meantime, let's have a look at some of the stocks that are in this. The obvious one is Facebook. Now, Facebook had a good close on Friday. If there's any selling in Facebook, the point in which I would like to engage is a full retracement to this big breakout here. So I would love to, in fact, I'm going to set alert for that for Facebook at 190, 188, 190. Because if we do, again, this is another bellwether. You know, this is a fairly big part of the Nasdaq. If this continues to hold up, then that is illustrating the confidence in the market. You can see we've now got, we've not come under that trend line yet. But personally, I certainly wouldn't buy up here. If you're not in a stock like this, I certainly would not personally buy up here. This could so easily go further. It could recover to 225, but I would love to see some weakness in this one, and that's the level at which I would like to get back to that. Anybody who's interested in Elliott Wave as well. So we've seen a 1, 2, 3, 4, 5 way to downside. 1, 2, 3, 4, 5. These are very rough waves. 1, 2, 3. So at the moment, that's actually this is a 5 and 3 wave uptick. So if the end of the 5 and 3 wave move holds, and you continue to close higher as subsequently, this is potentially a wave 1, a fresh wave 1 for another, at least a 3 wave move to the upside. So short term, there's still potential in Facebook. But personally, I do not like buying high, and I would much rather see that drop to the downside. Anyway, that's a good indication of what the market's like. If you look at, let's look at something like, look at Netflix. Obviously, it's a stay-at-home economy at the moment. Netflix has done well, so Netflix is still higher. Note how on the pullback we came down to 395. Let's just look at another one. So that's coming into this sell bar. I find that if you get a sell signal, it's very, very common for the markets to come back into that range. So again, if you're not in this, my personal recommendation is it is buyable all the time. You're closing higher, but you are buying at quite a high rate where the risk to reward ratio is not great. I would like to see that back to 400. So as we head in towards the key part of the summer, it's possible that if we get some what we might call bad hair days, if we get some selling, some dips, then that is what I would look for in that one. If we look at a couple of the healthcares, one of my favorite healthcare has been Medtronic. Now, this is good. Any time a market, and this applies to the Dow at the moment, this is 89-day average here. As a general rule, if you are under 89-day average, then you should, by my trade plan, sell highs. So at the moment, this was a lovely one as we came into 120, severe shock, decent push up from 72 to 102. So that's a decent leg up, isn't it? And now at the moment we are waving to the downside. So there's a gap down there. In fact, I'm going to alarm this one at, I would really like that to backfill at 85, 87. GE, good one. Okay, yeah. Anyone, stocks you're looking at, let me know. I'm going to talk about Forex and go back to some of the market indicators because I've forgotten to talk about the VIX and the dollar. But let's have a quick look, skim through biotechs and healthcare. And so, yeah, this is Gilead. I was trading Gilead in this box. So I had this box lined up last year and was talking about buying dips in this all last year. So no surprise to see this. This is a good squeeze pattern. Notice how the lows started getting higher in October and January. Now basically I see this as just a little bit too exhausted. The chart's got very, very untidy. I haven't bothered with it up here. Once we sort of big push up, and ever since we've been shaking. So Gilead is not one for me at the moment. Another one I have been trading is Bristol Myers Squibb. This was a lovely one on the way up from, again, this is another box play down here. Back end of last year. Didn't mean to do that. What I meant to do was the box. Hang on. I'll talk about what I'm doing this in a minute. Doing with this in a minute. So you can see we broke out of this box. Spent January to August here. August, September is normally a great time for biotechs anyway, because they have in the US they have conferences in this time of the year. So that's why I concentrate on it back end of the summer. So lovely wave up here, dropped all the way back into the 2019 zone, good push up. So now I would like to see, if we see any weakness in this, I'd love to see that back down there about 50, 55. Okay, so these are the ones, AstraZeneca, yeah. Let's look at, not traded this one for a while. That's a very similar picture to Bristol Myers, Regen. These are all, you can see how strong these are. This is still closing higher. So any weakness in these stocks is potentially a good place to get in. There's no guarantees in trading, as you should know. I'm sure you do anyway. But that's a sample of what I've been looking at in techs and healthcare. I do like stocks at about sort of 20, 25 to $40 mark. So I've got a scan list of those as well. Let's look at the other one I'm interested in. I'll talk about Astra in a minute. Let's just talk about Pfizer. Bear with me on these charts. This is I thought this is a good chart package, but unfortunately it's linked to IG data, and IG data can get a bit scatty. However, it does tell the overall story on this one. I'm buying dips in this Pfizer at the moment. I know they've had issues, but any push back into 35. So we are coming off here at the moment. If we dip back into that 35, I'm a buyer. If we close above, I'm going to buy some more, I should say. If we close above 38, then I'm going to have to buy higher. But ideally, I would like a pullback. Right, let's look at Astra. Are you talking about on the LSE or US? Let's look at LSE. In fact, I can't. Where is it there? So on the London market, this is struggling. In fact, that's a sell signal up there. New high, immediate close. In fact, it's done it twice, isn't it? And recovered. I would say it's struggling, but if it pulls back to 83.20, I think it's broken out from there. Right. Well, the market says, I mean, at the moment, I would say lower. But it's once stocks take off, it's much harder to predict. So a 1, 2, 3, 4, 5 wave to the upside. Actually, let me draw that a bit more. Pull that 5. That's a 1, 2, 3. If that's a 3-wave pullback, then this area here could potentially find its way higher. It's like I said, once if you're not in on some of these stocks at lower levels, it's much harder to buy once they start to break. If you're not in it, I would try and make out, okay, wow, 30 million doses by September. Okay, there's all sorts of stories on these vaccines. I was reading in the Observer about Oxford's work, and there's all sorts of stories dripping into the markets about, there's at least 100 projects out there, some of which are getting very, very significant levels of investment, and there's a bunch of them that is getting good data, but none of them are, as far as I can make out, none of them are having fantastic success. Oh, that's the same one, Oxford AstraZeneca. Okay. Well, like I said, if you're not in it, I personally don't like buying high. I would set an alarm for 83.25. Otherwise, if we start closing higher, I would just buy a smaller size and then get back in at a higher rate. But I think there are some other opportunities. I was going to say some better opportunities. I can't put my hand on my heart and say there's some better opportunities, but there are. I think is it. Excuse me. Let me just grab a sip of drink. Hang on. Disney, yeah, Disney's come up and a lot recently, so we'll definitely look at that one. You see, a stock like this one, it's got a lot of resistance above, but I prefer cheaper, good quality stocks, but with prices where you can get more leverage. The problem I've got with AstraZeneca is it's such an expensive stock. Even if you buy the options, you can't grab that many options. So I think it's better to try and find good quality healthcare and biotechs at some lower rates, and just make sure you do your homework and you're not exposing yourself to stocks that've got a higher risk attached to them. But obviously I can't go into too much detail about what constitutes a lower risk. But so if you're not, I'll maybe do a different session on that another time. Right, let's look at just choose, seeing as biotechs are quite popular here, let me just grab, there's another one, let me just look at this one, Baxter. Is it Baxter? Yeah, I was trading this one, although it's not a bit of a scrappy stock. This one was doing, you can see how I line this one up. Back here in 18 and 19, back in 18, this was a lovely one to trade. And there is your breakout pattern. If you ever see a chart with that kind of pattern, I'll just come back to that, hang on. That is a very, very significant pattern. So anything that's forming a base like that is potentially, so if you're trying to get in on the ground floor of something, look for that, because what happened here on this period, on the 20th, okay, it's Boxing Day, isn't it? Boxing Day for us Brits anyway. New low, close above next day. That was a fantastic buy signal on December 18. And you don't get much of an option. You get a chance to buy it. I'm just thinking more of the chart pattern. If you see this reoccur at any stage, so 4th of January, Friday 4th of January closes, does the same thing, repeats the exercise, but a much higher level here, and you get very shallow pullbacks. So maybe Astra is going to be like this. You get very shallow pullbacks. You'll have some bad hair days or some lower days to give you an opportunity to get in. I mean, it could be that AstraZeneca is going to be like that, where you just need to buy high and manage your risk and see if you can break out higher. But ideally, getting in on ground floor with something that's performing like that, with that sort of pattern, is very strong. And at the moment, this one's holding the 89-day average. So this is still a good candidate to me. Because if we subsequently close above that box and break above these highs, then that's potentially a bull flag. Okay, so that's the kind of thing I look for. And this is a good, the reason why I've drawn this to your attention is that this is only 87 bucks. So AstraZeneca is very, very expensive, but this is a good lower price, but good performing stock where you could get more leverage and potentially more gains, but usual risk management applies. Right, let's look at Disney then. Obviously it's a Dow component, so what this one does could have an impact. Again, ignore some of this data is not particularly accurate, but the overall picture's there. Disney looks higher. If by current prices, if you're going to pull back to 107 Monday or Tuesday this week, if you bought 107 or 105, 107, we'll stop under 100. So I wouldn't give it a lot of room. If I was going to trade this, I wouldn't give it a lot of wiggle room. At this stage, I would get a stop under 98. And if I got stopped out, I'd walk away short term. But I'd need this. If this is going to really give you a decent return, that's got to close above 115. Got to close above 115. Otherwise, be very careful. If we stay in this range and then start closing lower and go back under, start closing under 100, then that is not a good risk, obviously. But short term, it looks higher short term. Let me go through a few stocks that I've been looking at. Any other stocks? Let's have a look at what other stocks are you guys interested in? I want to talk about commodities in a moment. So I'm going to come on to and forex. Going to look at how the dollar's performing, particularly against the euro. I think what's happening with the euro is very, very interesting. I'll look at some of these, and PayPal. PayPal's had a great run. Look at that. So this push, this great shock, the demand shock, was fantastic for PayPal. Started to look good at 92, and here we are, having tested, well, nearly got to 146. If you're interested in PayPal, I would only, I mean, you're going to have to buy high potentially. I wouldn't buy that up here. I would look for 135. Any shock to the system over the summer, then 125 is the price to watch on PayPal. Cisco, okay. Zoom. So we saw some pullbacks. Obviously, you and I are talking on Zoom right now. So that 160 area, if you're not in Zoom, once that 160 may be a good pullback area. Notice how we got really wobbly here in the early April. So we get an initial breakout, 1, 2, 3 waves to the upside. Then we get the pullback to support, to trendline support. Then we go on another 1, 2, 3 wave run. So if you want to buy into these stocks, patience is really, really key. Patience is very much the name. Okay, yeah, I think the press loves to run stories on Zoom's problems because Zoom's had some security issues for weeks now. I've had to upgrade my Zoom app several times recently, so they're obviously trying to stay on top of that. BT, definitely. Right, let's have a look at Cisco first, and then we'll go to, because we'll stay with the US stocks, and then we'll go to some UK stocks. All right, Cisco, another NASDAQ, another Dow stock. Cisco. Again, it's only $44, so you can get some more leverage with that. Tends to be quite a slow stock anyway. Be careful with Cisco, because whilst the market has picked up, this has been. I'll tell you what's interesting about this. This has got relative weakness to me. I know it's a Dow stock anyway, but it's a tech stock, one of the very, very few tech stocks in the Dow. But all the time the Nasdaq has been firing up. This has, I guess it's gone a decent run, isn't it? We've seen the higher 50, lower 32 roughly, and here we are above 50%. We're above the 89-day average, above the fib zone. So we've got a gap up here. Look, 45, about 44, 45. We'll see a gap fill. We're 44 now, aren't we? So we do look as if we can poke up here to 46. I tell you what, I mean, if this is close above here and hold, we could come back and see 50 quite soon. But it's sluggish. I think they're better. I don't like it as a chart because we had a big up day here, then a big down day, a reasonable up day, and then it goes sideways. It's I guess from the point, at least it's not volatile. At least it's not just chopping around. At least it's grinding higher. So from that point of view, if you are taking a position that if you try and grab 43, you're going to know if you're wrong if you with a stop under that 41.40. Okay, let's have a look at so yeah, let's have a look at a few more Dow components. Let's look at Goldman's, because Buffett bought into Goldman's in 07, 08, didn't he? That's one of the. If we go back, look at the weekly chart. Yeah, Buffett got into this down here, I think, somewhere down here at sort of 65, 70. And that's the thing with if you are a long-term investor, some of these dips, some of the people who are buying Goldman's down here, they're going to be buying Goldman's for 1, 2, 3 years. they're not going to be buying Goldman's for you know, a couple to stay for a couple of weeks or a couple of months. Some of the guys who bought down there will be looking at that sort of 1, 2, 3 years ahead. So that close on Friday has engulfed the Thursday bar, so it's weak. I tell you what, I think, I forget what Buffett's doing or what he isn't doing. I think 150, 155 is the line in the sand for this. Let's take all this out. If we get down to 145, 150 and that holds, I think that's a buy. If we get down there and hold, because that support from 2016, we have had a lower high up here in January. We've got, so it's basically in a big channel, isn't it? That's in a big, quite a big channel formed from 2016. So I think if we come into 145, 150, I think that's potentially going to get bought. And I would again set an alarm for that. I keep an eye on Goldman's anyway, but I'll set an alarm just to in case it gets down there during a particular day. Of course, if we come down there and close under there, that's a completely different story. So I wouldn't just set a buy order down there. I'd set an alarm, see what happened when it got down there, and then look to see if that was worth buying. So have a quick look at one or two other Dow stocks, and then I'm going to go to some UK stocks, and then I'm going to look at commodities. Keep these questions coming because they're good. Thanks for your contributions, guys. Verizon, I'm thinking about 5G. So you look at that, that's a really nice low in the channel down there. It's quite significant selling. But if we can hold this 54, that's the main fire line for Verizon. If we, maybe we dip a little bit further, but if we come back and hold 54, I think that's a buy. And I think that's good quality stock in a good sort of utility style market sector to warrant some of my investment in that. So I would short-term happily go into that. That's the kind of, that's giving you an example of what I would look for. And I think quality is the name of the game in this business. You know, I'm just not risking on anything that has high debt ratios and so on. I'm looking for the better quality stocks. Right, let's go to the UK now and take a look at BT. Yeah, I am going to, so weekly, okay, this is a weekly chart. So we were just marginally higher on the weekly. We had, I think we had directors buying into this. We had what I call insider trading, not insider dealing, insider trading, where you've got directors buying into that. So 102, 101.50 is major support. On the daily, I think the daily is fascinating. I would love to get down, I think a lot of people would as well. I think if we come down and close that gap again at 102, that's a buy. Now, this is a good stock to look at from the point of view that this is, to me, a earnings trade. That's the earnings bar, 7th of May, came out of earnings. The market didn't like it, so gapped it down. But whichever way we come out of this earnings ratio, earnings level, sorry, is the direction for BT. And I know, Jessica, you gave me the story about valuations on this. I think I can't remember the exact numbers you gave me now, but this is something, isn't it worth? Isn't it valued at 10 billion? but with the sale of Openreach, it's worth effectively, if they realise their value of Openreach, which they're currently trying to sell, you could value them at 40 billion, isn't it? I can't remember the story now. So this is
I think the story was that the share in Openreach, they're negotiating that Openreach is worth 40 billion or something.
Right.
And so, and the BT is a lot more than just Openreach. So I think that it suddenly drew everybody's attention to the fact that if they sell this share in Openreach, then, you know, then the company is massively undervalued at its current value.
Yeah.
However, and that seemed to push it up to 110, just nodding under 110, didn't it? 110, 111. But then as soon as that happened, then it seems to be drifting back down. So I'm seeing this drifting back down towards the 102s, 101s. The reason it went down to the 102s and 101s originally is because it had a very bad hair day, because it had bad results, cancelled its dividend, and suddenly then Virgin and
yes,
O2,
O2, yeah.
Suddenly they've got a major competitor. And then there's all those question marks about the Premiership and the amount of money that BT sunk into sport. So they had kind of three really big hits, which haven't gone away. And so I think that the market valuation is sharpens people's focus on pulling it back up to 110 or higher. But still, you've got that fundamental story that it's not a good buy, because it's got all of these problems with a big competitor looming, no dividends. It always was a really good dividend payer, wasn't it? So
yeah,
that seems to be the problem. So I think that you've got this kind of push me pull you thing going on, and I can see that it could easily wobble its way down, couldn't it? It didn't manage to get it went up on the I'm just looking at the 30-minute chart on Friday, so it managed to get up to 111, nearly 112, and then it just came down, and it didn't manage to get very high, and it finished on 107, didn't it? So
well, the view I would take on this will be just based on that, on pure technicals. I would love this to come back down and trigger this alert, and if we can hold that in a 1, 2, 3 day period, I would go in full size down there, and then wait with a stop under here. I would risk a full size position if we can come down, hold that gap, and subsequently close above 109. Simple as that. Because yeah, this is a key part of my trade plan, to wait until you get earnings out of the way. Look at that earnings level the day later, and then line up the earnings bar and then see how the market behaves. Now, at the moment, based on that alone, all we're doing is chopping either side of the earnings bar. So that's the way I'm going to treat that. Love to, like I said, love to see that alert triggered. See if the market could come down and maybe even dip under these lows again, maybe even dip under 100. But if we can subsequently hold that, I would take a full position and hold on only if we closed above 109, 110. And then I would look to see if we can come back to these levels over here. Okay, thanks for Jessica. That's very interesting, and I think that's a good watch. I like that. A lot of big page on EasyJet in the Observer today. Stelios is squabbling with directors, but this is interesting. Yeah, it's sort of a UK bellwether in a way, because we all know that they're not flying. At least not flying to any, well, 90% drop in passenger rates. I don't know specifics with EasyJet anyway, but I mean, there is some hints that institutions could be dipping their toe in this one. That's the key zone here. If we open and close, I'm very, very wary about anything to do with travel and any public interface. But I'm not going to be buying this, but if this opens and closes above this level here, which I've got at 498, 500, markets love big numbers. If we open and close above here on one day, that could be the trigger for some sort of attempt to close that gap at 758. Let's look at Chewy. So you're saying, Jessica, it keeps opening and closing above that.
I mean, if you look at, for example,
yeah. So I'm talking about recent price action. I know it's open and closed above here in.
Look at the 7th of May. It opened and closed.
Oh yeah. I'm talking about from here on in. I appreciate it's open and closed above here at these periods. But I'm talking about what it does here from here on in.
Yeah.
If it subsequently closes above here in the next day by Monday, Tuesday.
The main issue, I think, the problem with airlines, and the reason I think it's really dangerous to go long on them, is because of this quarantine. Because nobody's, that's going to be a major problem for their business. That when a plane lands in the UK from anywhere, even from France, people have to quarantine for 14 days.
Yeah.
That's going to decimate their business for months.
Yeah.
So, okay.
Good. Okay. Let's move. Yeah, it's going to sort of rattle through this now. Let's just look at it. I'm going to quickly get on to commodities in a few moments. So Chewy looks the same situation, trying to pull itself up. My niece works for Chewy, so I hope she keeps the job. Because I know they are just about to start cutting BP. BP is struggling, so I'd be interested to see if BP can. Obviously, the price of oil is recovering, so if we come down to 280 and hold, I've got an alert set for 282. If we start to buy and hold in here, I would invest in BP. Let's look at Fresnillo. This is yeah, okay, so we've gapped up here on Fresnillo. Gold is holding up really well. A pound is weak. That's a big bonus for Fresnillo, because if they are trading gold in dollars as a UK company, and they then repatriate some investments into sterling, that is a double whammy to their profit levels. So you can see they're hitting a trend line here. If we backfill on Fresnillo at 693, I will buy Fresnillo with a stop under 660. Right, let's move to commodities now. So I started talking about commodities anyway, and then I'm going to wrap up. So I'll start by looking at the dollar index. The dollar index is still sideways. Any sharp increase in the dollar index, and I would be concerned about stocks overall, because you can see the massive leap we had up here into 20th of March. And bear in mind that markets reversed at 23rd of March. So the fact that the dollars showed weakness up here at that period was the heads up that the market could be about to reverse. But likewise, if this dollar gains strength, market fears about liquidity in the markets, I think it's going to be shown by that indicator, then be aware. So I'll come back to that. At the moment, with that, as long as that dollar doesn't close above there, then I think the markets could potentially hold up. In contrast to that, let's look at the euro. Obviously, the euro is the biggest. I've just shown you the dollar basket. The euro is the biggest component of that dollar basket. So you can see how I marked this 108.36. If the euro US dollar closes above that, that could open the gates for some higher euro moves. hard to see the euro, based on what the ECB is doing at the moment, hard to see that holding up. So again, be aware, if that a weak euro is good for the DAX, but a strong dollar could knock the US market off its stall. So no decisive decision in that chart, but keep a close eye on it. Right, gold. I've been a little bit too conservative on gold because that's a nice 3-day push. I was buying gold down here at 1685, got out before it dipped again, got out of resistance up here at 1720, it didn't get back in. I can't buy up here. I don't like buying high, so I need to see if the gold runs. I may be persuaded to buy higher, but at the moment I need a dip in that one. That's, like I said, there's no reason whatsoever to sell that. It's at resistance, so I'd like to think we can dip now, but at the moment there is no sign of that pulling back. And the last time we broke, if you look at this chart pattern over here, we started to get nice and high, gapped up, and then actually rolled over back in 8th of March. So let's just keep an eye on that one. Silver, again, I should have bought. I had an alert on silver, and it didn't get triggered. That's a really significant push. Wow. Any pullback to 1585 is potentially a good buy on that one. Beans, I've been buying it. I've been coming in and out of beans for a while. I've reduced my holding in beans. So what I've been doing with soybeans is I've been selling at the highs, buying back at the lows. But with that, a week like that, I've reduced my holding on beans because it's not performing. And so we've hit resistance at 865, 860, pulling back. I would love to see this come lower and then close, come back into that support and then maybe dip underneath it and then close up. So I think we could need a dip in beans. If we dip lower and close higher, then I'll buy back in and then see if we can close above 850. Because if we do close above 850, I think we can go on a run. In the short term, it's lower. Whether or not that can close higher, jury's out at the moment. Other commodities, if you look at wheat tends to, the grains tend to move together historically. Let's have a look at the wheat now. So that's under the trend line, but holding the big $5 in wheat. So again, if that dips into 490 and closes higher, then I'd be in. So we've not come down to the fire line yet. Weakness still prevails, but I'm keeping a very close eye on it. Otherwise, sugar's had a good run. That's dipping back. Cocoa's got a lot of problems with 1990. So I think that needs a good, healthy pullback. 1865 will be a price for me. I'm not sure it can get that low, so I'm not touching it. I will wait. That's it. We've been talking for just over an hour. So, right, anybody not involved in our newsletters and trading room, come on to this website, which I'm just about to give you. Find out more. The next session we do is on Wednesday at 6. So if you would like to join that, I'll just give you a link in a moment, if you bear with me. Right, so this is, for those of you in the room who don't know us, this is tradetheeasyway.com. You can see down here is the alert for this session. Keep an eye on the briefings for newsletters, and take a look at the trading room is a day trading room, which we talk about stocks and forex as well. So come onto the courses and look at Scalper School. If you have not done it, if you come into this and have not done a starter program, then take a look at Starter Point. Okay, final call for questions. Just aware it's the weekend, I'm soaking up some of your weekend. So that's the website. Email me or contact me on any of the contact page for information. Otherwise, the Wednesday link, if you would like to join us on Wednesday, is here. Let me just grab that. It's taking time to come up. And it is here. All right, so as soon as I found this link, which is just literally appearing, Forex, any particular currency pairs you're interested in, Kent, before I go? Pound yen, okay. Let's grab that. Oh, wow. Thanks for drawing my attention to this. Let's look at US, where's US dollar yen first for our comment. That's a negative sign for the markets for me. Normally, US dollar yen follows the markets normally. So with the yen being the currency with the lowest, or traditionally had the lowest base rates, everyone else has raced to the floor as well. That's holding up above the 50%, but under the 89-day average. That's, in fact, it's gone nowhere for quite a while, really, hasn't it? But pound yen you asked about, so let's look at pound yen then. Wow, that is looking lower, isn't it? That's showed a complete lack of confidence in the pound to me. Oh, look at that, right on a fib zone. Oh, right on there. So if we close under this 129.60, that bodes really badly for the pound yen and the pound overall. I noticed I've been watching the euro pound as well. We'll look at that in a second. Lower, definitely lower at the moment. But wow, that's a major. We're on the fire. We're closed on the fire line on Friday. Fire line being a price that, if breached, could really open the door for some much lower numbers. Look at euro yen. Yeah, so the euro is much stronger. If you look at the euro pound, that's had a decent leap up. So if that could follow through into the euro US, if that's above a 50% line. So next stop 90.32. Parity is right up there at an extension. So if this one continues higher, we hold that breakout pattern. So that Friday close was very significant. Yeah, a lot of negative news coming in about Brexit negotiations, and I think the well, the markets are shocked at the levels at which the current chancellor is shoveling money at the economy, unlike the Europeans. So at the moment, the Europeans are shoveling less of a lower percent of sovereign debt at the problem than the Brits are, than the current chancellor. So, and that's showing through in the way in which they're dumping the pound. So some fundamentals, yeah, you're quite right, Jess. Some fundamentals to do with, yeah, Boris has always claimed, UK PM has always claimed that he'll be happy for a no deal, isn't he? And there's some very, very basic arguments that are splitting Europe and UK at the moment. So yeah, a lot of strength, yeah, much more strength coming to the euro as the pound is showing weakness. Now normally, let's come back to the FTSE for a second on that, because normally a weak pound is good for the FTSE. Because there's so many FTSE components who trade in dollars. So whilst there's no very limited techs in the FTSE, a weak pound could give this a welcome leg up. So it's very fragile. Any close under that 56.63, and that will open the gates for lower numbers in the FTSE. So that's a very interesting level to watch for. In fact, I need to. We haven't looked at the flick across to the German DAX as well, doesn't it? Literally just hanging on. And that's quite a contrast to, you can see this is under 40%, coming down to 38.2, whereas the Dow, even the Dow that's lagging, I've not got the, that's the latest fib range. Okay, so the Dow's not significantly higher than Europe. It's only the NASDAQ, it's only a tech index that is significantly higher. So this is not far out of step with the Europe indices. So it's, yeah, keep a very close, so we need to keep a very close eye on this 24,000. Because if we just dip up here in the Dow, and like I said, I've got 24,260, but the fibs have got 23,900. If we just nip up there and find a lot of sellers, that could be a good structural failure up there in the Dow. So you can see, you know, I started off by talking about the importance of the dollar and the NASDAQ in terms of, you know, trying to gauge where this market is going next. But you know, we've got some key levels in the FTSE that support right underneath us right now, and the ability for this Dow to close above 23.9 or 24,000 is going to, that's the only proof of the pudding. So although the Dow is holding up short term, there's everything to play for. I think we're going to know, I mean, certainly if we've got to continue to at least hold this low and got to close higher to have any significant chance of holding up. Otherwise, if we just start closing lower here, get under that 22.5, then this is in trouble. Okay, so markets are at that juncture, that point where we're holding up, but if momentum does, if we do lose our footing, we could see some significant dips, but overall we're holding up. So at least we all know exactly what to look for in the coming 1 or 2 days. Yeah, if we're closing lower by Tuesday, then be warned, be very careful. But if we're closing, on the flip side of that, if we're holding 23.9, 24,000 as we're getting to Wednesday, then there's a reasonable chance we could start to climb to 25, 25.2 and higher in this Dow. At the moment, the Dow is showing a willingness to hold up. All right, thank you very much for your company. Like I said, anybody who wants to come into the trading room, anybody who wants to, then let me know. And I'm assuming that most of you in the room are at least basic fluent, if not intermediate, maybe even experts. Maybe you're an expert, I don't know. But check it out and stay tuned. Watch out for the next events, Wednesdays and midweek updates, and next Sunday. Enjoy the rest of your weekend and bye for now. Thanks everybody. See you.